going to spend most of my time today with a piece that I've edited from Mohamed El-Erian. And he's talking about really how do we chart the course going forward in the economy, both the economy in the US and the economy in the world. And I will explain. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is July 30, 2024. As I said, I'm going to begin, my primary feature is Mohamed El-Erian. He is speaking or being interviewed by a guy named Willie Walker, who I had not heard of before, but who runs the firm of Walker and Dunlop, and they are the largest or one of the largest financiers or packagers of commercial real estate loans in the country. They're doing a conference and they're giving him an opportunity to speak, and he actually speaks for about an hour, including a Q&A session, but his presentation is 26 minutes. What I've done for the sake of time is to edit that and condense it to what I think are the most salient points for about 12 minutes. So this is going to take 12 minutes of your time, but I think because of who Mohamed El-Erian is and his insights and trying to edit into the best pieces of it, I think you'll benefit a lot from it. If you care about what's going on with the macro economy in the US and the world from a fairly neutral standpoint, he doesn't kind of take one position or the other, politically or economically, market-wise. He doesn't really get into the market very much. He's more focused on economics, but it's extremely insightful. So if you listen to him, you know what I'm talking about. So I'm going to play that, and what I wanted to comment on was that he makes a couple of things I want to just make a statement about. One is the Fed, and he's said this many times actually, the Fed is data dependent. So the Fed, very important decisions coming out of the Fed because they determine really our monetary policy, the value of the dollars in circulation, interest rates, which stimulate or slow down the economy. And all of this is done by the central bank called the Federal Reserve Bank. And he's not a fan of what the Fed has done. But one of the statements he makes is the Fed is data dependent. And you think, well, that sounds okay. They should be data dependent. But he doesn't mean it in a complimentary way. What he's saying is that, I imagine it this way. The Federal Reserve, or the Federal Open Market Committee, is sitting around in a conference room, a table, and they are passing around pieces of paper like this. And each one of them gets their piece of paper and they look at it. And from that, there's a discussion, and then they make a decision off of a piece of paper that runs and then therefore their decision significantly affects our economy and the lives of people. I imagine the alternative as being, what if they had people commissioned by the Federal Reserve Board that went around in various cities or towns in America, and let's just say they interviewed 1,000 people, small businesses, average businesses, people, manufacturing, wholesale, distribution, trucking, retail, all kinds of businesses. If they interviewed 1,000 of them and came back and said, here's our collective input of what we think is going on in America, you'd say, that's not data dependent. That's what people are saying. That's what people are feeling. People like you and me, and then make their decision around that as opposed to some numbers on a piece of paper. So anyway, he comments on that. I just kind of elaborated a little bit. And he says the world has gotten very complicated. It has. As you look at the world and I look at it, and I've told you before, I don't have a TV. I read my news on the internet, and I limit it to that. And if I did it otherwise, I would I would watch too much, I think. But we're at a tipping point. Doesn't it feel that way? We're at a tipping point, a turning point, where life in the future may be very different than it is today. And so he's kind of looking at the question based on all of the economic input that he gives. What is the world going to look like for you and me going forward? And because he is so thoughtful, so smart, I think you'll appreciate this. So if you're open for 12 minutes, stand by. I think you'll enjoy it. If you're not, I do understand. So take a listen to Mohamed El-Erian being introduced by Willie Walker.
To have someone like Mohamed here to speak to us, who is not only a PhD by education, having gone to Cambridge undergrad and gone to Oxford for his master's and for his PhD, but to then have gone to the IMF, to the World Bank, on to Solly Smith Barney for a stint in Europe before going to PIMCO, running PIMCO's emerging markets investments, then leaving PIMCO to go to Harvard University, ran Harvard Management Company, then went back to PIMCO to be co-CEO at PIMCO, to have run PIMCO as successfully as he did, and to now be both the president of King's College, Cambridge, as well as the chief economic advisor to Allianz, which owns PIMCO. Many of you have seen Mohamed on CNBC on a very consistent basis. I have to say, you have a real insider's perspective at the Walker & Dunlop conference, given the amount of time that both Mohamed and Barry Sternlicht spend on CNBC. I think you basically have gotten CNBC's perspective on the entire world today and tomorrow. But I have watched Mohamed. I've listened to his insight and thoughts on the economy. And I think one of the things that is hardest for economists to do is not only predict the future, but be consistent to the things that they look for in economic data. And I think one of the hallmarks of Mohamed and why he is so good is that while the data may change, he has a framework with which he processes that data and gives all of us insights to give us a sense about what's coming up. So with that, I will turn the stage over to Mohamed El-Erian.
So let's start with a bit of history. August 2022, Jackson Hole. Central bankers get together. They're all waiting for Jerome Powell to talk for about 40 minutes and take questions. He gets on the stage, talks for 8 minutes, and leaves. And uses the word pain a few times. The US economy is about to experience significant pain. Why? Because we're having one of the most concentrated interest rate hiking cycles that we've seen since the 80s. So of course we're going to see pain. Of course we're going to see unemployment. Of course we're going to see a recession. 2 months later, Bloomberg Economics comes out and its model predicts 100% probability of a recession in 2023, 100%. They were right about a recession, they just got the wrong country. It happened in the UK, it happened in Japan, it happened in Germany. What happened in the US? Exceptionalism, economic exceptionalism. High growth, declining inflation, buoyant markets. And Willie put up the graph that compares us to other G7 economies. And we've completely outpaced other economies. Now, that was not the only forecasting problem. Inflation also was a problem. 2021, the Fed uses that awful word called transitory. There's nothing more dangerous than the word transitory. Because when you tell somebody something is transitory, you tell them it is temporary, it is reversible, don't worry about it. Look through it. Huge mistake. But that's not the only mistake. The Fed's forecast of inflation has been consistently wrong. In the fourth quarter of last year, we were supposed to be on a disinflationary trend. All that went out the window in the first quarter. So you have growth being a problem to forecast. You have inflation being a problem to forecast. And when you have central banks trying to get over inflation, you get the problem of the last mile. Look at the two middle clippings. They are from the Financial Times. The first one, central banks sent victory over inflation. The second one, the great bet on rate cuts is off. The difference in those two was 30 days. 30 days. We've had the most enormous amounts of Fed policy pivots that we've ever seen. Economists love the notion of forward guidance. Forward guidance means the Fed tells us what they intend to do, and we do the heavy lifting because we believe the Fed. And if we do the heavy lifting, then the Fed, by the time it does what it needs to do, is an orderly adjustment. The problem with forward policy guidance has been totally inconsistent. It's been all over the road. I mean, look at all these headlines. It gives you a sense of how confused the Fed itself has been about what's happening in the economy. I say all this because we now have to go from the past to the future. And you need to answer 4 short-term questions. The first question is the following: will US exceptionalism continue? And that, I will argue, is a function of the Fed. We are starting to see significant weakness in the lower ends of the income for households and in smaller businesses. Tremendous pressure. The only thing that's keeping them going right now is income. They've run down their pandemic savings. They've used up whatever debt capacity they had. Some of the small businesses are having to refinance themselves at significantly higher interest rates, and they're being really squeezed. The question in everybody's mind is this general weakening, or is this what's called the K economy? Meaning lower end goes down, upper end goes up, and on average, everything is fine. This is a critical question because the Fed is data dependent. So if the Fed is data dependent, there's a risk that it may not appreciate how much the economy is weakening, and it may be too late in cutting rates. And if it's too late in cutting rates, we go into recession. So the first thing you've got to figure out is how will the Fed react? The second thing you've got to figure out is what's going to happen to China and Europe. They're trying to bounce back. They're structurally challenged. And they have a trade-off between short-term stimulus and fixing what ails them. How will they get this right? And I'm going to give you answers for all this in a minute. The third question is what's called the swing states, the middle powers. We don't talk about them much. When someone presents about the global economy, it's the US, China, and it's Europe. But you have a set of middle powers that are becoming systemically important. And they're being squeezed, they're being pulled by China on the one hand and the US on the other hand. How will they respond? This determines things like oil prices, determines all sorts of stuff. And I'm going to argue there's a set of countries, and if you get good at your flags, you see the top ones: India, Saudi Arabia, Turkey, UAE, and Brazil, that can play China and the US off. They can live in the in-between. But there's another set of countries, Australia, Singapore, New Zealand, Mexico, are going to have to make a choice. And if they don't make the right choice, the global economy gets a lot more complicated. And then the final question has to do with tech, AI. There's a massive competition going on, and there are 2 poles emerging. How will these poles coexist? So think of a world that's being shaken from above, and then think of a world that's being shaken from below. Why is it being shaken from below? Because there's at least 7 sectors going through fundamental change. Technology and generative AI is going to fundamentally change not what we do, but how we do it. Life sciences is going to change a lot of how we live. And sustainable energy, as Willie said, is something that we're going to have to somehow find a way of doing, and doing it in time. And then you have 4 other sectors: defense, healthcare, cybersecurity, and food security, that are going to be very deterministic as well. So you're living in a world that's being shaken from above, you're living in a world that's being shaken from below, and you've got to predict the future. That's really hard to do. So what does the future look like for me? So I'm going to conclude, because Willie asked me to say something about a book that 3 of us wrote during the pandemic. In about 2016, I got an email from a Gordon Brown. I was in California. I got an email from a Gordon Brown claiming to be the former Prime Minister of Great Britain, saying, I read your article, I want to come to California to discuss it. So I printed it out and took it to my wife and said, who do you think is pulling our leg here? And she said, I don't know, but respond to him. So I responded, I said, I'd love to discuss it. When are you coming? So he said, I'm coming on so-and-so. I said, great, I will make a reservation and we'll get together for brunch. He said, if you don't mind, can we meet in your house for security reasons? So I thought this was going to be a really good test. So he was supposed to come on a Sunday. On the Saturday, the Secret Service, the British Secret Service turns up, because prime ministers have protection for the rest of their life. And they start checking the house. And if you want something that makes you feel really insecure, it's those people in the house. Because they say, that window doesn't shut properly. Anyway, he turns up the next morning. I had not even reread the article, so I couldn't remember what I had written. And he stayed for 6 hours. And then we developed a friendship. Come the pandemic, he decides we should have a call every week during lockdown. And after about 2 calls, I realized I wasn't smart enough to deal with him. So what do? You bring in someone else. So I brought in another friend called Mike Spence, Nobel Prize winner. And for a whole year, the 3 of us would have a call every week. And it was a really depressing call. The vaccines aren't being shared properly. The policymakers don't realize that when you shut down an economy, you can't simply turn it back on by flicking a switch. Things will be in the wrong place. And then we discovered that most of the crises going back 20, 30 years had 3 common elements to it. 1, the inability to grow in a durable, inclusive, and sustainable manner. And you all know, as business leaders, when you don't grow, things go wrong because you can't afford your mistakes. And if you start making mistakes, then you get into what economists call a path dependency, where the likelihood of making another mistake gets higher and higher and higher. The second problem is that policymakers tended to make a lot of mistakes. And this is really important because we're living in a world where the Fed is likely to make another mistake. And they tend to make the same mistake over and over again because they lack cognitive diversity. And then the third element is there wasn't enough cooperation. I say that because your judgment on these 3 factors is going to be important. And I'll leave you with a hopeful note as Willie comes back up, that we have answers for all 3. And all we need is political leadership.
I hope you found that helpful. Next, I want to play a couple of pieces that I think actually are kind of the same message, but they do come at it a little differently. One is with Liz Young, and she's in a discussion with Guy Adami, and they're looking at, I want to play for you the piece in their interview, which is looking at charts from Carter Worth charting. And there are a couple of charts, but they both rely on charts a lot, that I look at, and I look at these, the S&P and the NASDAQ, and I say that the S&P is breaking down. It has broken its trend line and is now in a downward move. You could say that. When you look at the NASDAQ, even more so. It has broken down and is now in a way below the trend line and is not looking very good. So you could say from a stock market standpoint, these are not positive indicators. The market is not in an upward trend. I don't mean today or tomorrow, but I mean just in general, it's broken the trend line. So that's one point of view. And then I'm going to play another point of view that might be similar, but coming at it from a different angle. So I want you to listen to Guy Adami and Liz Young.
Let's look at the S&P 500 because that's our want to do. And let's throw up the chart. This is our channel. It's a worth charting channel, which is not easy to say. Seemingly, we have breached the lower end of that channel. We'll see how long it lasts. But I do think this is important. Elizabeth, I know you look at charts from time to time. You and I actually rode up in the elevator together, and we said something akin to risk does happen fast, and you're starting to see it around the edges today.
Yeah, I mean, I'm no technician, but looking at this chart, I don't think that's how it's supposed to look if we were in a sturdy upward trend. So there are some questionable things going on in the market right now. There's also a lot of commentary happening on the macro front. There was a paper, I believe, by Bill Dudley that came out today talking about the Fed needs to cut rates now. So now we've got all this speculation about maybe we'll get one in July. I don't think we will. Maybe we get 50 in September. And it's just the anxiety is rising. And after a market having rallied so much as it did, we're now seeing, which is something that I've talked about, I'm sure you guys have talked about too, when selling pressure comes in, people sell the easiest stuff first. And sometimes they might have a reason to if there's a fundamental weakness going on. But the easiest stuff to sell first is a lot of that large cap space and everything that has gained so much, because you look at your portfolio and you say, where can I trim? I trim where I have gains. And that's those names. So that's part of what's dragging some of this down. And, you know, small caps haven't seen too much of that pain, but they may as time goes on.
Well, they've just seen massive underperformance
for a long time.
years.
Yes, but they had this huge run up. And now I think what's keeping them elevated is that yields continue to come down.
Yeah, no doubt. I mean, listen, those charts, by the way, so the S&P 500, let's throw up the NASDAQ, the NDX, the NASDAQ 100. You know, Carter was with us yesterday. He went through these charts. We talked about the relative underperformance from the highs of the NDX, and that just speaks to the rotation we've seen into the Russell 2000. And so, guys, this is interesting to me because, again, this didn't even make an attempt at that former uptrend, right? And you ask Carter the question, right? And, you know, Carter, you know, made this point, and I'm really glad that he did. If we want to toggle back to the SPX chart, is like, listen, these trends, they're not, you know, they don't always have to be perfect. And if you look at that, that is to the penny. But let's just say, for instance, we had this bad break. And if we don't close on the lows, let's say we make up some of the losses towards the end of the day, and let's say it closed near the high of the day, and then it follows through to tomorrow. So that's how you can get faked out a little bit by just looking at the charts, which I'm glad you brought the point up about rate cuts, because obviously this is a bit of a macro thing on top of the earnings that we've seen over the last week.
And the final piece I want to play for you is of an interview with Ed Yardini, and he says we are going through a correction, meaning the month of July. We're going through a correction, but it's just a correction, and he expects the market to move on up from here. That, in a way, is similar to what Liz Young is saying. So it's not, I think what they're saying it differently, and maybe they're looking at different time periods. But I think both of them are saying we're going through some kind of correction. I don't think Liz Young was saying, by the way, I want to mention this, I don't think she's saying, and the whole market is headed down from here in a significant way. I don't think she's saying that. Matter of fact, I think she put it in context to say she's not. So, but anyway, this perspective from Ed Yardini, I thought, would add to what Liz Young has said, and I thought it might be helpful to get a perspective on the market as of right now. Take a listen.
Now to Ed Yardini. Ed, we are hitting new lows here, you know, down 2.4% or so in the S&P 500. Kind of easy to say, well, we were entering a tough seasonal period. The biggest stocks in the market were crowded and expensive. We needed this pullback, but is there anything else going on that would concern you?
I think you covered it all, Michael. But look, I think that usually in a bull market, you do every now and then get some sell-offs. And this one is a nasty one. I think it's going to turn out to be an official correction in the Magnificent Seven. But I think you're also saying, as you pointed out, that some money is going into the rest of the market. It's not everything is down today, but the big decline is in the Magnificent Seven. I think that when you look at the underlying fundamentals of the economy, I don't think we're going to get an economy-wide or S&P 500-wide correction of 10% to 20% because I don't see a recession out there, and I don't think investors are actually worrying about a recession, given that the Fed has basically promised that they'll lower interest rates if that's necessary, and I don't see a bear market. So I think this is a sell-off. They happen from time to time. This one is nasty because it is a correction in the Magnificent Seven.
Okay. I don't know what this means, if it's a compliment to those in the investment business or it's something not so complimentary. But I saw it and I thought it was funny. So thank you for watching. If you have questions or comments, leave them in the comment section below. Thanks.